Hi, I'm Keith McCullough, and welcome back to round three. Thanks for staying the whole way. Many of you watched the call this morning, you do the macro show, then bang, 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 you do 1, 2, 3 on Real Conversations with three of my favorite people in the business, because they can really help you save and make money. So Mike T's got to be, when it comes down to actually giving you the trade, and a Hedgeye hat he's wearing, this is like I'm like too much in love with Mike T. You got the pink ETF, you're doing it for, basically, you're doing it for free. I mean, how many people would do something like that? Congratulations on pink. People are making money on pink, which is great. Pink is the ETF that Michael Taylor runs, of course. And thanks for wearing that with, even though, Hedgeye, maybe we should get you a pink one.
Thank you so much. Well, I was just telling Keith before we went on, I'm sorry, I got this off of Alibaba, so it's Chinese. It's a knockoff. And but I get what I get, free shipping. So.
Oh my God. So for those of you that don't know, if you can't tell, Mike Taylor and I are good friends. Please don't cancel. We have a lot to talk about. Quite frequently we'll talk on the phone, and he's one of the few people out there, when we talk about putting it on, like when you go negative, like I'll be like 15, 20% net short, not Mike T. Mike T puts it on like in much more size, first of all, than I do. And he does it in a way that's just like explicit. So I want to start with that. And again, with a picture, hope you don't mind me showing, you talked about the Payne trade. It's a great tweet. For those of you that don't know, Mike's son, Max, is an incredible kart racer, okay? But this was not, this was a bit of a wreck, right? Is this what happened there? You said the Payne trade?
That was the final lap last weekend in NOLA in New Orleans, and my son was battling it out with number one driver, and they both wrecked on the final lap.
Oh.
And so that fella got to finish in like P10, and Max got DNF'd because because it was all bent up. So if you see at the bottom left of that picture, that's kind of golden thing there, it's supposed to be straight. That's a tie rod. And so he couldn't drive, and it actually got tangled around the brake apparatus. So he didn't. But he's running top 5 in the country now. So he's really come a long way. Big shout out to our team, Mike Doty Racing. And I'm so happy that he's part of that team, and it is the best thing ever. I encourage everyone to get racing because
I love it.
It takes every single skill you got to do it. It is nail biting, intense, sweaty, angry, smoky. It's got everything. And forget about that electric racing stuff. We don't do that. We are straight fiery gas. And, right between your legs, these kids are running around 80 miles an hour with a plastic gas can between the legs. That's a big crowd pleaser with the mothers. They love that crap.
Sounds like they would be. Now, can you talk about, there was a point there in March. I remember I was going to see the dentist. I couldn't move one arm. I'm like, Mike, I'm getting ripped 6 ways to Sunday every day on Twitter in the macro show queue. That was at the pretty much at the end of the rally in queues, and then you said Payne trade higher, bullshit.
Always, they always tell me that. And
what does that mean?
Remember that. Well, the Payne trade they always say is higher, and that's really a lot of our Wall Street friends. Their entire career is bet on that assets go higher so they can stuff you with more paper and more deals. So their hope is for higher all the time. And usually the Fed's behind you, engaging in that to, when things are bad, they print. So, and that makes assets go up higher. And so the real Payne trade always is down. It's always down. Because everyone cries when it's down and nobody cries when it's going up. You got a handful of hedge funds that do, but this represents sub 1% of the money that's trading out there. So it's nonsense. The Payne trade is always down every single time. Like Apple breaking its trend line right now, I'm looking over at it right now. That's Payne. That's Payne because if it's 2% lower, everyone's selling it because everybody owns it. Mm-hmm. And that's how it works right now. Look, I was just at the track this weekend, and I was talking to one of my friends there. He's a broker. I'm not going to say any names. And a very nice fella. And he's telling me what he has his clients in. And he shows me a list of these names, and I'm literally I'm short 2/3 of those names, and one of them Peloton. And I'm just like, what are you doing? This is literally going to zero. And he goes, yeah, but it looks really cheap. And you have to remember that most people, and I mean even professionals in the business, they believe that things are good at a company if the stock is up. And they believe that it's bad if the stock is down. And if it's down enough, they're going to buy it for a quote unquote trade because it'll get taken out. But they don't know any of the facts. They don't know any of the valuation. They don't know any of the free cash flows. They don't know anything. And this is what they're recommending to put in people's portfolios. And, this is what happens. It gets in there. And so everyone in the world basically has Microsoft, Google, Apple, and now they've sold a little bit of Facebook because the stock went down, so you got to sell it. Same thing with Netflix, stock went down, so you have to sell it. And so now they're super crowded into a really small list of names and equities right now. You got staples like Costco trading at 45 times forward earnings. Sorry, I'm looking at my monitor right now. They got Microsoft, Google, Amazon, and Apple, and that's their book. That's about it. Walmart, Costco. And the biggest trade right now, if you've been watching, has gone into large cap pharma in a way that I didn't even see this in 07, 08, this kind of violent blind rotation into sea of names they don't know anything about. It's absolutely fascinating. It's also very difficult to manage that running the Pink Fund, which, as maybe many of your guests don't know, that's a healthcare specific actively managed ETF, and I do run that, and so I'm vexed in a position sometimes where I see the flows and what they're doing, and sometimes the ideas that they're going into are not good ideas at all, but they don't know it right now. They don't care because it's just get out of whatever is going down and plow into whatever is going to be economically insensitive, and that's kind of the rotation that we have right now. It's really fascinating. I can't remember it being this violent in the past, even in 08. And that might be a cause of the M2 or the money supply, and that money supply over the past 2 years has lifted about 50%. So there's still an incredible amount of money sloshing around, and we don't have redemptions yet. We don't have redemptions yet. And that is something to keep in mind meaningfully, because when we do, and I believe that will start in May with the great sucking sound of the Fed selling assets into the market, I think we're looking at a really, really hard time for stocks. In fact, we're probably setting up for probably the worst setup that I've seen in 20 years, all my years of investing.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there, subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content. You tweeted that on April the 6th, by the way. Guys, you can show that. And my simple question was, why did you use that chart in particular? I don't know if you guys can see that chart yet, but I'm sure you remember the chart.
I'd love to see it. Oh my God, this chart.
Yeah.
I mean, I'm not a valuation guy. I keep track of it, I follow it, but I look for like magnificent extremes. And the extreme here is absolutely stunning. The financial assets divided by the percent of GDP in which they are. And it is at well, as you can tell here, this is wild. And this is really a product of what we've witnessed over the past 2 years. The great MMT experiment, modern monetary theory, is underway. It happened. It happened. We sent blank checks out to everybody. And they turned around and spent it all, pretty much. And here we are on the hangover. And the hangover looks like this, where the comps are impossible. And the margins that most of these companies enjoyed in 2021 are going to be looked back upon as lifetime, all-time high margins for many of these companies in the S&P. And they will never, ever be duplicated. Yet Wall Street all-wall, as you put it, is modeling for the most part for margins to stay very, very, very high.
Which is
and part of that is, it's really because, look, management guided this way because, as I've come to understand, for most companies, management has honestly visibility of 3 weeks. And so they have great difficulty planning that way. And we have to keep in mind, though, that this is the guidance that they told their board that they will attain. And in many cases, their compensation is based upon hitting these numbers. And it's beyond a long shot. So it's
the comparisons that Mike's talking about, I use this slide quickly, just show it again, slide 52 in the current macro deck. I mean, in Q2 of last year, S&P 500 revenue growth was 25%. If you look at different sectors, it was like 38%. Earnings growth like 410% for industrials, 212% for consumer discretionary. I mean, these are like batshit crazy numbers. So when Mike says you're never going to see that again, that's a pretty easy comment to make. Never's a long time, right, Mike?
Well, not in our lifetimes. We won't see it. And I actually think that we will never see another COVID-like event or MMT attempt like we've seen, because recall, 2 years ago, a year and a half ago, the whole world was saying, see, printing money and delivering all these paychecks or whatever, it doesn't matter. It doesn't have any impact. And honestly, you look back at history and they say that every time. And everybody wants free money. They got it. And surprise, we have a problem with inflation. Now, this is going to comp out, meaning the compares year on year will become easier and easier. But there are certain things here, like I got my little Fed sheet here for my, let's see, what's going to be a big problem? Food's going to be a huge problem. Energy is going to be a big problem. And the rental rate equivalent, which is 24%. Of basically 24%, if you will, of inflation is going to be a real problem actually for many years. That will be a problem. And food is going to last for over a year. And energy, I don't know, but it's going to be at least a year and likely more, a lot more.
Yeah, on an absolute basis, it absolutely will. I mean, if you look at the turd sandwich, can we pull up that tweet, the turd sandwich? Mike Taylor's special, the verdict is turd sandwich. Another chart that I want to make sure you explain, because again, a lot of people follow you because you're good at picking stocks, obviously, but this is not for everyone, but you're like, this is the only thing that really matters above and beyond everything we've talked about. I'm sure it's all embedded in it, but guys, can you show that?
Yeah, the chart?
The tweet is on April the 5th. I'm sure you guys can find it because if you word search turd sandwich, turd, yeah, there it is.
Yeah, that's the balance sheet, baby.
What is that?
That's the Fed's printing press right there.
Holy shite.
Yeah. So it's actually really amazing. And I called you like in a feverish pitch from a racetrack one weekend, and this was recent, and I was like, oh my God, one of my friends who's a big fund of funds guy, second biggest in the world, so it's big. And he sent me a slide, and he was explaining to me why the Fed was only going to do $20 to $30 billion of quantitative tightening. And it's because they said they want to reduce their balance sheet, which is what we're looking at right now, by about a third, but relative to a third of GDP. So the argument was, well, GDP is going to grow by like 5% every year for the next 3 years, so they only have to do a very little bit of quantitative tightening. See? So it's bullish. Buy. And I looked at it and I said, and this is when I called you immediately, I'm like, you need to know this because this is crazy. I was like, so what happens if GDP only grows at 1% or no percent? Does that mean that they have to accelerate quantitative tightening to meet their goals? Yeah. And it was just like crickets. They're like, boom, So it's
double shite on the turd. It's like, but that's always the case. I mean, if you can. It's essentially the secret, to the universe, which is calculus, of course. But if you can just stay ahead of the Fed when they're wrong at the turns on both growth and inflation. Last year it was wrong on inflation at this time. This year, absolutely wrong on growth. And I think most people, since now everybody talks about inflation, they're forgetting the growth part. The growth part of both real GDP growth which is subtracting all the inflation Mike mentioned, and real profit growth and jobs growth. I mean, we're just coming off the mother of all cycle peaks in growth.
This is very, very, very important for everybody to understand that's an investor, in my view. And I'll say it here again. I've said it many times, and I need to say it every time I'm on a program. Everyone has to remember what the Fed's job is. It's not their dual mandate. The dual mandate is just verbal diarrhea for the masses. What it really is to make the Treasury look solvent. So, and you can see it in their policy right now, where if we have 5 or 6 or 7% inflation, right? Well, shouldn't they be jacking up the 1 to 5 year yield to like 5 or 6% or something like that? They're never going to do that. And the reason why they're not going to do that is because most of the Treasury, meaning the debt of the government, US government, is financed between 1 and 4 years. And if they hike that up to, let's say, 4.5%, over the next 3 year period, the current debt is yielding at about 2.5% or so, and it's actually a bit less now because yields have been lower. And the financing of those coupons will go up to 4.5% or something like that on the 1 to 5 year yield curve. Well, so what? What does that matter? Well, it's just like everybody with their teaser rate and their credit cards. The rate goes up for the government. And the government right now is spending about 15% of tax revenue to pay those coupons. If that coupon doubles or goes up by 70% from 250 to 450, well, all of a sudden the government's going to have to dole out 30% of tax revenue to pay the coupon. Mm-hmm. And when you back out GDP for the US, all the growth in GDP for about the past decade has been due to government largesse. So we turn into the death doom loop where the government can't spend because they owe so much in coupons. So, and we can't let that happen because we run into the death doom loop where we have inflation and negative GDP growth and essentially the potential for a run on the dollar in some regard. And so for that reason, I believe it's not about the election, in my view, in November, what our good friend Kyle Bass said. I actually think it's about finding a spot on the yield curve where the Treasury can finance at a low yield. And that will be an inverted yield curve. And they're going to tank the economy so that they can finance the federal government at a low yield, so they don't run into the paying out 30% of their tax revenue as coupons. Because, I mean, think about that. That's our entire military budget, or Social Security, or Medicare. And we can't come up short on that. So what'll happen, if that happens, we'll have to borrow more to pay that while yields are going up. And that puts you into that kind of doom loop. And so they have to keep yields down somewhere on that curve, or else it's certain doom. And they can do that by tanking the economy. And I think that is the plan. And so forget what the Fed says, watch what they do, and scratch your head and say, what are they really doing? And I think it starts becoming much clearer then.
Yeah, I think right now, I mean, I was back and forth with Mike Green on this, and it's like what you see on the page is not what they're going to actually be able to do, you know, in terms of like raising rates 9 times with market conditions that look like days like today or last week for that matter, as opposed to, you know, how would you characterize kind of the noise, if you will? There's a lot of noise coming out of Fed heads. There's a lot of yip yap and chatter all amongst our friends on Wall Street about who said what and when, versus just economic gravity. You know, what would you say to that? A lot of people still think that what the Fed says they're going to do is what the bond market's actually going to do.
Well, if that were the case, we would see the Treasury yields like 3 years out being much higher, or even 2 years out, much higher than what they are now. And I believe that they will not have a ton of, an incredible number of hikes, but they're going to accomplish their means with quantitative tightening,
right,
which won't have as much of an impact on those 1 to 4 year yields. So that's why we're seeing a big effort to use that way to tighten rather than to hike rates. Because in hiking rates, they're going to increase the coupon for the federal government. And they don't want to do that because, like I mentioned, we turn into the doom loop. And the reason why there's a doom loop, unlike where in Japan there isn't a doom loop yet, is that every year we have to find 41 to 44% of our investors in the Treasury from outside the US. And so we have to find a logical buyer, whereas in Japan, it's all internally controlled. They basically said, okay, every pension fund, you have to buy this much Treasury. And when they don't have a buyer, they just print. And so it's all internalized. There's no foreign buyers. And so it's like a captive audience. And that's an amazing thing to watch. I recently tweeted when I saw the yen and, well, actually it was the yield on the JGBs lifting up to 25 bips. And I said, we are like literally 30 seconds away from them printing their brains out. And so this is another great example where you should watch what they're doing, not what they say. Remember that Kuroda at the BOJ has said that we want inflation to pull us out of this funk. And that's our goal, and that's why we're printing money. So as soon as they get some, they print more.
Yeah.
And that's exactly what they wouldn't have done had they been telling the truth the whole time. They'd be cutting their printing press and reducing that because, oh, mission accomplished. We've reached our goals, or we're reaching our goals. And that's not it. It's all fake, as I like to say, kabuki theater, right? So now he has to print more. And that's a huge problem. And as a consequence, you just saw the yen drop 10% versus the dollar.
Yeah.
So now inflation is even worse in Japan. And what they're basically trying to do is, starve the people slowly and take away their buying power because they have a demographic and debt bomb like no other. And they don't have a choice. So that's why every single time they go and get tough, they're going to print more. Because the moment that they pause, slow it down, whatever, asset values will absolutely implode in Japan so fast you can't believe it. And as a cause of that, the hurdle rate will lift for all of these corporates, And as we also know, that corporates have been borrowing money for a decade or more, almost for free, and rolling up the whole world of crappy businesses. So they have very low hurdle, low margin businesses with debt behind them. And so it will fold up very, very quickly. And so here we are. He's basically starving the people slowly by destroying their currency. But the alternative is to blow up immediately. So they will choose the long road.
It's amazing that, like, when they tell you kabuki theater or not, like when they tell you the truth first, their currency goes down faster. That's been Japanese yen short against the dollar, and then you got the euro short. They're like, QE, we're gonna stay with it. We're definitely not gonna do the American style interest rate hike program. So that was a great euro short. Let's just get into it. Some people actually think, I've had people on the street, like people like not Wall Street, I mean people just out on the street think that they'll say that I came up with this one-liner because I have a lot of one-liners, but this is your one-liner. This is your one-liner on HedgeyeTV. It's like
there are so many.
So Mike Taylor's the first person to teach the at least Hedgeye Nation, don't be right, make money. Okay? Now again and again, people that follow you, that follow I, that follow anything, they're constantly being triggered and steered to hear people think and opine with narratives on how this and that and this and that. And they don't make any money. So is there anything to add to what made your one-liner famous?
Well, you have to get it wrong a lot before you come up with that one line.
Yeah.
And you sit at the desk smashing your face against a brick wall, and you have to reach. In order to be successful in a hedge fund, and the kind of hedge fund that I ran, which was very old school, neutral-ish, although I ended up taking pretty large directional bets in my last years of doing it, really because they just gave me a lot of rope to do it. But you really have to think about how to make money and what would be the max Payne trade, because that's usually the right one. whatever is going to cause the most number of people, the most amount of pain, that's usually what happens. And so you have to skip being right, because being right is a crusade. You know, you're on a crusade. It should be this way in life, in policy, in politics. And, you know, you shouldn't spank your kids. Well, guess what? Some people do, and there's nothing you can do about it. That's it. So you just have to grin and bear it. But how do you make money at it? Because that's our job. Our job is to just make money. And it's very, very difficult to clean the slate in your mind constantly and decide, how do I make money this month and this month and this month? You know, just think of it as a clean slate, and what would be the most painful thing that could happen, and always kind of put a little bit of that trade on. But it is really challenging to think that way. And it's a challenge for me too, even though I say it. And that's why I say it all the time. Skip being right.
Well, I mean,
being early is being wrong.
You're very good at loading the load. When you think you're going to be right, I've seen first of all, I see a lot of hedge fund managers, a lot of long-only managers. They're my clients. I've been doing this now from this seat for 15 years. That's starting to age the old troglodyte himself here. But the people tell me, people trust me, so they tell me what they're long. They'd like for us to like what they like. Don't forget that there's that. I'm well aware of that component too. But you're one of the few guys, or gals for that matter, that goes big, and I mean big, top down, but also bottom up stock position. So maybe use a couple examples on how to make money. You went big, you said, a month or two ago when you went big on UNH, Lantheus, like as soon as I see these positions in the pink ETF, Taylor's in the, people, not only are you in there, but people like me aren't dumb enough not to follow, okay? Because I know what your slugging percentage is. So and there will be a day, and we can call up some stocks that aren't working for you, which might even be a better lesson. But what is it, like maybe use those two examples if you don't mind, or one of the two on why you went big in those. Those are home runs in a down market.
Yes. LNTH, Lantheus, is a large position in the pink fund. Basically they have a better mousetrap imaging agent, and it is going to become the standard of care for marking cancer. I don't want to go into all the details of that because that'll take an hour, but I looked at it and I said, nobody knows about this. They just got approved, and the expectations were very low, and I thought it would be completely wrong and revolutionize the standard of care. And shortly after that, the company agreed with that, and the market agreed with that, and the street numbers were probably 400% too low. So, and it's still a double. It's more than a double, in my view.
Yeah.
And that's, if you look at it, there's only like 3 old wall analysts covering it, which is the weirdest thing.
Yeah.
Nobody covers it. And it's just one of these rare things that slipped through the cracks and nobody's paying attention. And look, this is what I do. I find things that people don't understand yet. Or at least I try to. And also with my team, my critical mass team, which is all the guys that I've worked with over the past 20 years. And so we talk about this all the time. UNH is going to be, actually the HMOs, including UNH, are going to be, in my view, the only group of names that are going to be beating and raising numbers all year. And it might actually be the only group of large cap names that beat and raise numbers in the S&P all year.
Which is a huge, partly why people have had to flow. People ask me a lot, like, hey, why were energy stocks going up when your oil signal was breaking down? It's because money managers flow into equity. They don't own the commodity. So it's a lot of chasing goes on when people have to find that. At the end of the day, trying to find the safety of a cash flow stream during Quad 4 is one of the most important things when you're picking a stock in Quad 4. Visibility, right? And that, for UNH, I guess if you're a large cap manager, you just got to own that visibility.
Yeah, it's big in the benchmark.
Yeah.
And they will. And they're figuring it out now. But there's so much money that they have to move that they've also plowed it into pharmaceutical stocks. And about half of those large cap pharma stocks, I think, are modeling basket cases. To the degree where one of them is going to have to cut the dividend in about 4 years. And that's huge.
That's bad.
Meaningful, like literally get rid of the dividend, stuff like that. So I don't want to say which one of those, but it's a bad one.
Well, those, I mean, I find my healthcare team, like Tom Tobin, who runs it, he and I have worked together for over 20 years, which is dating ourselves. I mean, he always says that some companies, like in your world, are just like unmodelable. But when you get into these other ones, like I'm just looking at your top 10 again, like Horizon Therapeutics or Shockwave Medical, these stocks on my signal are golden. They're bullish trade, bullish trend, up in a down market, generating alpha. Are those names, those positions you have less than, for you, there's for most they're the biggest position they'll ever have. For you, they're smaller than your biggest positions, which can be triple that. But do you have a max on these sizes of positions? And also, if you want to talk about either of those two names, have at it.
Oh, sure. Horizon is at least a double. They have some data coming out later in the year for repeat treatment of their lead drug. It's a drug that essentially cures blindness for people with thyroid disorder.
Oh, wow.
That's kind of a bug eye disease. People will know it as that. But people go blind from it, and it's the only drug to treat it, and it has about a 95% efficacy. So it really changed people's lives. It's a big ticket drug. It costs about $300,000 a year, and there's no approval on the label for retreatment. And that data will be coming out later in the second half of the year. But when you stick that into the model of retreatment, where patients will come back every 2 or 3 years for another $300,000 ticket item, that's unbelievably big money. So that's about $3 to $4 billion of perpetuity that is not in the model. That is I do not believe that Horizon can stay an independent company after that data.
Now I'm asking you about stocks, and you're better at telling me about stocks. So why don't we do that part of the conversation?
Yeah, no, I got a handle on a lot of names. Of course, everyone's going to ask me about PCT, which I've lost money on. That is a pure. I'll get my hat. There we go. There we go.
Oh, there you go. Now, did you get that from China too, or what?
I did. No, I didn't. I stole it from the company when I went out to the plant there. So they're short one helmet. Get the OSHA guys on them. So Pure Cycle is the only company in the world that can recycle polypropylene waste. And it's a 1.2 billion market cap company, no revenues, but their first plant is going to be up and running at year end. And what people are going to find out is that it's not one plant. It's going to be multiple plants in Europe, multiple plants throughout Asia. They have many partners already there and on the way. Company never has to raise money again. And the first 2 plants that they are building in process right now in the US will generate about $500 to $600 million of EBITDA. And that's the first 2 plants. There are going to be dozens worldwide. And so I am near, and I'll be frank about it, I am just under a top front page shareholder, and I'm also...
You personally?
Yeah.
Oh, man. That's...
Wait. Do you think we're playing games here? Is this games? Is this games? This is games.
And this is not in... So people, like, we were going through names that are in his pink ETF. He's talking about his PA, which... I can assure you is of consequence in terms of size, and just referencing where you'd be on the what he means by page is like when you list the top shareholders. That's what he means by on the page.
So what you mentioned though is when we talked about it coming into the year, I was like, this is the worst setup year I've ever seen, and there's no way I'm selling that PCT, because even though I know it's a small cap name and it'll get drilled like all the others, and it did. Because I don't know when they're going to figure it out, but it is rare for me to find a name with a 30 to 40x return in it. And I've done this for 20 years, and I've found 5 trades like that in 20 years. And so I think that there is a high probability there, and I've done an awful lot of work on it. And I'm early. I realize I'm early. I don't mind being early. And that's one of the big reasons why I was at times this year 70% net short. And that was so I could keep that name. Oh, you want to laugh? Hold on.
That's not
I'm
a
just
lot.
looking at my book
Not a
right
lot of
now.
people will do that. Not a lot of people will be 70% net short. So for those of you
At times.
that have stock picks, that you know what that means, what he just said was critical in terms of how a hedge fund manager thinks about positioning. You're allowed to keep the things that you think are going to make you a lot of money when you come out of the cycle or throughout, if you have the other side of the trade on, which is called all the factor exposures, small cap, leverage, high beta, that are going down anyway. Okay, when you're net short, you have more shorts than longs. You said minus 70% currently?
No, at points this year, I was minus 70%. I probably averaged around 35, 40% net short. I'm currently minus 41% net short, and 1.5% lower. I'm a bit over 100%. And the only reason I have that trade on is because this rally, remember, you got to suck them in before you blow them out. And that's important to know too, because they just sucked them in bad in the last rally. And I was able to get some really, really great options on in size, a little bit lower, and out for many, many months. So it's basically going to cover me through the start of quantitative tightening. And that's probably where things start going blotto very fast. Blotto is an important technical term for junk bonds. It's also what we call patients that went into cardiac arrest when they're on the table.
Yeah.
They go blotto. So, I think after we start quantitative tightening, blotto.
That's when P.E. Powell gets the phone call that I was talking about from Carlisle, when people are going blotto on Wall Street. That's a good one. Actually, here's a question on PCT. If you don't mind, I'll ask that one first.
Throw it at me.
It's Nathaniel Epstein. I'd like to ask you a question about PCT's technology. Of course, without giving away any proprietary information, I'd like to get a sense of this tech, why it's different, especially given that PCT has said that the process uses already available technology.
Well, the guys at Procter & Gamble, and what people don't realize is, how did Procter & Gamble make a technology like this? They don't do this stuff, this sort of chemistry, petroleum sort of things like that. Many pharma companies, including P&G, which had a pharma division, and they have a lot of scientists there that's what they work on. On Fridays at P&G, you get to work on whatever science you want, like pet projects and stuff like that. And so you have a lot of science guys working on these things that are just their own intellectual curiosity. And surprise, surprise, a lot of unbelievably valuable things come out of it. So if you do make a discovery like this, yes, you get some credit inside the company, you get the gold watch, but it's owned by P&G. And so this is sort of how many things like that can come out of P&G. And in short, how they do this recycling polypropylene, you take waste polypropylene, and under pressure and heat mixed with butane for the most part, and butane is in your lighters, it's a fluid under very light pressure, and it will dissolve the polypropylene so it goes into a suspension. And from that, you can run it through filters and literally spit it down in a centrifuge to take out the impurities, and then run it down the line. It's basically a big line of tubes they do this through, and then they cool it and remove the pressure, and the polypropylene precipitates out. That's a very classical application in chemistry, where you precipitate out things that you want at a certain temperature and pressure. And then they literally scoop it out and put it in pellets. And that's it. And they patented it, and nobody can do it. They own the technology for at least 15 years. And then on top of that, they're going to have, probably hundreds of patents on top of that for the optimization of their process over time. So this is very likely a monopoly with pricing power that'll have an indentured footprint and essentially own the input supplies from the waste management companies. I think it will have no competition forever. And there's incredible demand for recycled polypropylene that is what you would call virgin. meaning it doesn't go into Chinese widgets and toys. This can go into food stuff. It can go into medicine bottles. It can go into cars. And it's essentially the identical purity and caliber of original polypropylene.
Now,
it's one of the best ideas I've seen in years.
I'm thinking Mike Taylor just gave a clinic on what he knows about a company in a very short window of time to communicate what he knows. That's impressive, man. I like that. Before I take other people's other questions, Mike, are there any other stocks you want to talk about, or do you want to hear their questions?
No, you can ask me about pretty much anything. I have a view on almost probably, I have no idea, 50% of names in the S&P. So
it's another thing that you have that's so unique, is that you can look at so many things and then zoom into one thing, and then zoom out, toss it, get something new. I mean, that is one of the keen characteristics that you have. When I look at all the people that I've seen do well and survive this business, like you said, survive not having multiple blottos. That's a big thing. Being able to consume a lot of information, have a lot of ideas on the board, take them off dispassionately. You're really good at it, and people should understand how you do that.
So kindly. Spoken like a true troglodyte.
Troglodyte nation. He's the first one. When he first read my research, he was at a hedge fund, of course. I think you're probably at Millennium. You were there forever. And you're like a troglodyte. For those of you that don't know, that's the inside joke. And I think I've been called worse. All right, here's an interesting question. We've had this question a couple times, but this one's got a lot of votes, and it's from London. And this is bigger picture, Mike. Do you think the market is thus far following the 2008 trajectory with a sharp pullback coming in mid-May? If not, how do you see it unfolding?
That's a great question. It's like 2000, except that the Fed can't cut rates. So it's like Thelma and Louise, but it's not on a movie set, and it's real. So yeah, it's exactly like that. Except not at all.
Back then it didn't work anyway. I mean, same thing. We can show the history of yield curve inversion coming out of 1999. And then the Fed eventually figured it out, and they're pushing on a big string. So
the big difference is that the debt numbers that we're talking about globally, because everything is global and fungible, and it is unbelievably meaningful, those loads of debt. And it's not a big deal right now because you're measuring it coming off of all-time highest margins ever. That can never be replicated. So as the margins drop back down, that sort of free cash flow yield is going to drop in aggregate everywhere. And we're going to start seeing that in 2Q and 3Q and for many Qs moving forward. So it is in many ways, it is very much like 2000, but you also have to take a step back and say, well, what is not like 2000? And it is the glorification of the most speculative thing you could possibly imagine, which I call digital Pokemon cards, which is crypto. Crypto is, it has no yield. It makes no sense. Nobody's ever going to use it. There are 1 million different coins that you can buy, and they essentially have no future whatsoever. Yet everybody I know owns some somewhere. And that's the problem, is that everybody I know owns some. That sounds like an incredible number of sellers as the cost of capital.
Sounds like a lot of sellers. I was just going to say when you said it, nobody, I'm like, I don't own any. But you know what? It's not true. I would be lying because Jack McCullough's accounts, we talked about Max. I have Jack, you have Max. He's going to own that shit for the rest of his life. That I'm going to make sure. He doesn't want to talk about it anymore. Every weekend I'll be like, hey, Jack, we log into your Blue Ocean or whatever the account's, what's the account called with the NFTs? I obviously don't.
Oh, don't ask me. I mean, that's even worse.
But it's like he took some of his birthday money and bought it. So now I'm gonna let him wear it. Like he's gonna wear it. He's not gonna be able to sell it. He doesn't want to even log into it. So it's not just us. It's our kids. It's in some cases their kids, depending on how old you are. There's a lot going on out there. Here's a question from Arthur Hanlon, and maybe you just answered it. What is the max Payne trade today?
Oh my God. That is so good. Okay, here's the Max Payne trade today because I'm watching it. All right, and I'm thinking Max Payne trade today. I got a few. Delta Airlines puts up like awesome crap on Wednesday. All right, and everyone will be like, "Oh, you got to buy airlines. This is great." Yeah, no, cruise lines will go up more. Cruise lines have a lot more leverage. So the trade would be long calls on Carnival Cruise Lines into Delta's print. They're super cheap, and it'll trade probably at a correlation of 1 to Delta. So it's probably a great trade. I like that. The Carnival Cruise Lines into Wednesday for the trade. So that's like Max Payne. Another Max Payne is Bed Bath and Beyond.
Oh,
Because I am. Oh man, there's a lot of shorts in it, and I don't. I have a nominal position. I've just been thinking about it, and
long
I was
bloodbath?
thinking. No, it could go either way. That's why it's Max Payne,
Oh, okay.
because this is a big deal. Because this is we're at the beginning of seeing the margins fall apart. And you don't know which management team has the visibility to see it, because some are better than others and have better logistics than others. And so I think that this quarter is going to be a bonanza for longs and shorts in consumer stocks, consumer discretionary.
Yeah, that's
I think tech is dead, but there's going to be a lot of pain there no matter what happens, and it's going to start with Bed Bath and Beyond. I really don't know what to do with it, but that will, no matter what, it will be the max paid trade. If anything, if I had to choose, I would be long Bloodbath for the Q out of spite. Because if they aren't, if they're bullish or whatever, like, it's going to lift the whole space, and there is a lot of shorts in that space right now. So I'm really vexed. In fact, not only that, I am net short that space. I have a lot of hedges on the long side, so I'll probably be all right. I mean, like, for instance, I bought calls in Nordstrom. I think that company is a complete disaster, but everybody's short it. So if consumer starts to lift because Bloodbath isn't like so bad, or they just lie to us about the future, Nordstrom could really move. And so that would be the Payne trade right there.
Yeah, knowing pain trades it's so important to know and to have the institutional knowledge or community of contacts. Mike Taylor talks to more people, if only because he mentored more people than pretty much anybody I know in the hedge fund universe, and he shares. Not everybody does, right, Mike? And
I do share.
And there are some people that share, but they're not honest sharers. Okay, so but Mike, you don't hear anything but what he thinks. Whether he's right or wrong, he's going to tell you what he thinks. Whereas the other types of community giving types are thieves in some regard and trying to rip you off. So you got to be careful on who's telling you what. But if you're really good at it, Mike, isn't it true that they don't know that you know, but you know what they think they know, and you'll still talk to probably those guys anyway, or know somebody who can?
Well, look, I'll talk to anybody at length if I think they're bright, and especially if they're telling me things that I didn't think about, even if they're not right. That's okay, because at least they're telling me something that I didn't think about, and that's really engaging for me.
Yeah.
Because like, you and I are cut from similar cloth, and all we do is just think about this stuff. It's more of an obsession. It's a compulsion, and that's okay. You're born that way. There's no problem. This is what we do. So I enjoy it greatly. And I'm vexed by this quarter on consumer discretionary. And then if it's not that bad, you're probably going to see a nasty rotation out of pharma, because a whole bunch of people that shouldn't be there are there now. And it's going to be really, no matter what, there's going to be incredibly violent rotations until, I believe, we hit the beginning of quantitative tightening. And we might even rally just a touch for a day on the day they announce quantitative tightening. And everyone can say, the bottom is in, it's perfect, no problem. And you sell that. And
I think Kramer called the bottom a couple times this year, didn't he?
Yes. Yeah, a couple times. Yes, many times. Well, there'll be many more times that he can call the bottom too. So I look, when the big sucking sound shows up, and I talked to a big allocator, and I said, all right, this is what I want you to do. I want you to call all your debt books that you're allocating to and find out who wants to buy the Fed's book the first day that they start selling it, and then the second month, and the fifth month, and the eighth month. Who wants to be the buyer? And he gets back to me. He literally got back to me, and he goes, oh my God, it's nobody. I'm like, of course it's nobody. It's nobody. So I think that once they come in and they start selling, everything starts selling. That's it. And the same thing happened in '08. If you recall, and I do distinctly because that was my first full year as a PM in '08, that stocks held up. They held up and held up and held up all the way to September of '08. And the reason why they held up was because the Fed was lowering interest rates and lowering interest rates and telling us all that they're going to afford us a soft landing. And, you know, it's garbage, you know, it's words, you know, to do this. And so as soon as the shit really hit the fan in September of '08, then they started selling. They really started selling because they had to. Here you're going to have a very large seller showing up into the markets every single day. We don't have a lot of experience with this. Remember, the last time that we saw the Fed roll off their balance sheet was 15-16, right? And everyone turns around and says, oh, stocks went up, it's great, ... However, we had the biggest tax cut in history and corporate earnings went through the roof and buybacks went with it. So this is not then at all. This is just selling at peak margins off of impossible MMT comps, going into a global food crisis that will have great duration, a global energy crisis that will have great duration, problems with input costs everywhere because there's been investment in mining and exploration for over a decade because they can't get those operations funded because of ESG. No one's allowed to invest in this stuff. So there's real structural problems that exist, and they're all coming kind of into a head, going into impossible comps with the Fed showing up as a gigantic seller. You know, if you asked me to figure a worse setup, you ever see that movie Armageddon?
Yep.
That would be worse.
Oof.
There it is.
Yeah, the deep quad 4 I've seen, but I've not seen this one. And that's the thing that people, you know, a lot of questions are, well, is it like this or is it like that? In some ways is what you've been saying, you know, throughout this conversation. But what it's really like is now. That's what it's really like. Because again, when you conditionally factor everything that's happened in human history to today, tomorrow's only going to be a function of that. It's not 2008, it's not 2000, it's today. You know, so you did a great job, like taking us around the world and back again, there, man. With all of your again, and I think what's really helpful to people is to hear someone articulate it so succinctly and specifically with trades, like things that I'm going to do, and that's you, Mike Tia. That's why everybody loves you, man.
Troglodyte. That's it. Oh, I got my little wand here. This helps.
Oh, there you go. That'll help you all the time. Now we're out of time, but thanks a lot, man. Appreciate it as always.
Thank you so much for having me. It's been a pleasure.
He is the one and only Mike Taylor. Who else is going to wear a Hedgeye hat, pink, wave the wand? Tomorrow we're not going to have that. We're going to have people that do it their own way. We're going to have Buddy Carter. We're going to have Daniel DiMartino Booth, DDB, and we're going to finish with Jim Chanos. So looking forward to seeing you all back again. Thank you for spending the time.